Hello, accounting students. Today we are talking about ledger count. So we are going to start learning some of the foundational skills around bookkeeping primarily, but it all leads up to accounting. So today we're going to learn about a couple of key concepts. The first one is this idea about a ledger. Now, we've been referring to different things in a business, typically by specific names. So we've talked about like the cash or bank account. We've talked about accounts receivable and payable for specific people and businesses. We've talked about the capital account. Now, what's common to all these that these are all accounts. These are all parts of the business that we keep track of. Collectively, when we put them together, or the device we use to keep track of them together is called a ledger. So this is, as we're going to see in a minute, this is kind of a collection of different accounts. So it's important to understand kind of visually how that looks. So basically, from just a total theory perspective, an account is a specific record about a specific item that's held on the balance sheet for a business, or it can also be, there are also accounts for revenue and expenses as well, as we will learn later. And so what we do then is when we set up a business, we set up a specific account for each specific asset, liability, and owner's equity item. And then as we add to the business or take away things from the business, sell things off, whatever, we will add or subtract accounts as necessary. The ledger then is this group or file of accounts. And sometimes businesses can have either only one ledger, like if it's a small business for all the accounts, or alternatively, they could have several ledgers. So if you have a lot of accounts receivable, you could have an accounts receivable ledger, or a lot of accounts payable, you could have an accounts payable ledger, and so on. And so then obviously with bigger businesses, different departments would be in charge of looking after each of these. The other thing that we're going to learn about today is what's called a TAccount. And basically, it's not technically an accounting document. It's a tool that accountants and bookkeepers use to sometimes puzzle things out, keep track of stuff. We are going to use it to do transaction work. So that we can learn about how to process transactions, where things go, and how to keep things balanced. So some important features of TAccount. So as you will see, the reason we call it a TAccount is that it's shaped like a T. And then just like we would give a ledger account to each item on our balance sheet and income statement, when we are doing our work, we're going to set up a TAccount for each of those items. Typically, the way it's set up, we'll see an example in a minute. At the top, we put the name of the account, and then on the first line of each, we will set aside for the opening or beginning balance, or what's called the balance forward from a previous time zone. Typically, and this is a really important lesson to remember, and I'll reinforce it in a minute, the side of the balance sheet or of the accounting equation is where the beginning balance normally goes on a TAccount. So for asset account balances, the opening balance would be on the left. For liability and owner equity accounts, they would go on the right side of the TAccount. We also use what's called a reference number to keep track of our transactions, and I'll show you all this in a minute. Right, so this is a set of TAccounts, a very, very simple set of TAccounts for a business where we only have 3 accounts, one from each class. We have one asset account called cash. And so if you look, here is the T that I talked about. Okay, we would put in our account of the name of our account. We then have a liability account, in this case bank loan, and then owner's equity where we have the capital account. Typically then what we're going to see then is you're going to see values listed under the T, and either increases or decreases as the case may be, and we'll learn about that tomorrow. The opening balance, so this reference number usually you'll see in this column here or this column, because there can be numbers on each side. The opening balance for a cash account, because it's on the left side of the equation, we're going to put it on the left side of the TAccount. By the same token, now that we go over the equal sign into kind of opposite world or bizarro world, as they call it in the comics. This is now our opening balance is going to be on the right side of the T account. And so here's a very simple transaction where we have added $500 to the business, and then that is composed of a $300 loan and a $200 investment in capital. And so we can see right away that this transaction is balanced because we have equal amounts of stuff on the left side as we do on the right side. So we would know that our accounts are balanced. Typically, in terms of formatting, things on the left side of the T account will be right justified. So this $500, all these values here will be right up against the line. And same thing with values on the right side of the account. They are going to be left justified towards the middle. So this 300 here is going to be up against this center line, not over here at this side of the box. The other thing is, and we'll see this when we add in more numbers, is that we don't leave like blank spaces. So if my next transaction to cash was going to be on the right side, if it was going to be a minus, I would put it right up here next to the 5. And so it wouldn't be like kind of a tic-tac-toe thing. There would be a list of numbers here and a list of numbers there, and then with their references on the outside. Now, the last thing to talk about is just this reference number. And again, it's something that we're going to practice in the future, so don't worry about it too much at this point. But basically, whenever you do transactions in the real world, you're going to have things like receipt numbers and slip numbers and stuff like that. You're going to have transaction numbers like 1, 2, 3, 4, 5, or A, B, C, D, E, F, G, something like that. And then you're going to use those so that you can cross-reference transactions later. So right now we have this opening balance kind of transaction. If I want to know all the entries related to this opening balance transaction, I just have to look for all the letters OB, and I would be able to match those up and be able to make sure that I'm balanced. When I do transaction number 1, all the entries for it, I would list with a number 1 and the reference number over on the left or the right, depending if it was an add or a subtract. And then that way, if I wasn't sure if it balanced, I could go back and I could check, oh, there's a number 1 here and a number 1 here, and I could see if they're the same amount and if they would balance. Again, don't stress too much about all that in detail. We are going to practice that over the next couple of weeks. And that is our lesson for today on T accounts.